What's going on, everybody? It's Jeff here. Welcome back to the channel. Amazon reporting awful earnings and lower than projected estimates going forward. Stock dropping 20%. Market pulling only for the bulls to step in and break us back out of that channel we've been talking about for quite some time. I want to talk about next week. We've got the FOMC rate decision on Wednesday, followed by the elections on Tuesday. Going to give you an entire breakdown. So let's get right into it. First off, let's talk about this channel, that 356 to 380 that we've been bouncing off back and forth for about 4 weeks now. Now, I said to everybody inside the group, in order for to feel some confidence to go long, I want us to come back and retest that 380 to show that once what was old resistance becomes new support. Another thing I mentioned to everybody, which has been very common, especially in high volatility bear markets, are these failed breakdowns and failed breakouts. Okay. We saw this happen on CPI where we broke through that 356 only to just get ripped right back into it. And if you were short on the market at any point in this time, obviously you got shredded. Okay. And it's understandable why you get short. You look at this chart, you can see that we're breaking down out of a certain pattern and it looks strong. And obviously these setups do not follow through as often. This is very common during high volatility and especially in bear markets. And we've seen this on a larger time frame as well as an intraday. Okay. So if there are times where you are getting stopped out, you are getting faked out, just know that it is much more common in the past year than it normally is during a regular bull market. Okay. So that's exactly what we saw today. Amazon had their earnings. Apple had their earnings. Apple really carried the entire market on Friday. Okay. I said to everybody, in order to feel confident, all right, to go along on a longer dated swing, with some calls dated out until December timeframe, I wanted this 380 to test and to hold on a larger time frame. I'm looking at the 1 hour. If you look at that, the daily, obviously it held because clearly here we are sitting up at 390. But I look at it between a 1 hour and 4 hour time frame, I want to see it hold. And clearly it broke through. I said to everybody pre-market, it is the only way I would want to go short on this. I don't want to get overzealous, is if that 380 rejects. Okay. And it shows that we're getting back into this. We broke through the one, so it was previous resistance. Okay. And it's acting as resistance once again in order to continue to go short on a longer time frame. Bulls stepped right in and it was a perfect grind all the way to the upside. Okay. Now this takes us into next week. Right now, the bulls are in full control. All right. If we zoom out just a little bit further to the daily time frame, okay, you can see that we are getting up to some serious, resistance levels. That 392. There's been a lot of activity, a lot of consolidation. All right. And expect that to happen leading up into the FOMC, which it normally does the couple days prior. And this is going to be on Wednesday. So expect that to happen on that Monday and Tuesday. Like I said, it just generally happens. Now, this brings us to the elections. I want to talk a little bit about this before we get into the rate decision. It kind of coincides together. Okay, so keep this in mind. So first off, here's a beautiful article, and I'm going to break it down, talk about the key points, rather than showing you just a bunch of different charts that show all of the data. I'll show a couple charts, but so the market usually rises after the midterms. Will this be any different? Now, this is a study. This article goes on about, like I said, all the studies talking about the presidential cycle. All right. And there's a lot to it. And I want to break it down for you. So right now there's overall pessimism inside the markets. We've seen it. Everybody's still calling for more downside. I had mentioned that 350 was a very, very big target. In one sense, looking at the charts from a completely just technical standpoint and just the structure setup, there is a little bit more room for the downside, especially for, the futures getting down to that high 3,300, low 3,400 area. And that's just from a technical setup. When you're talking about the macros, inflation running rampant, okay, we're still raising rates. The fact that, a recession is, if we aren't already in one, even though GDP came back up, that the economy did grow a little bit. There's a lot to talk about and a lot to go over when it comes to the macros. Obviously, that hasn't changed. That hasn't even turned yet. But it is very good to not be biased, okay? A lot of times when you get biased, that's where things, you really get shaken up because you feel like what is going to happen inside the market. Nobody knows. We can only react, okay, to what we see happening on the chart. So Here is just an excerpt from from an investment research chief. He says the recession may already be priced into the markets, in which case the next bull run may be faster and come earlier than many investors expect. So I have two takes on this. One, markets are very forward looking. We've been talking about that for well over a year on this channel. Markets are very forward looking. However, they tend not to go as deep as really the line, or farther than the line is drawn. And what I mean by that is, if you look at where the markets, were moving back in April and in May when, Jerome Powell was talking about just raising interest rates, inflation was already peaking at that point. The market was starting to price in what his anticipations were. And obviously, considering those, expectations and outlooks have changed drastically over the last few months, the market continues to price that in a little bit deeper. So when it comes to this fully being priced in, I don't think so at all. Now, on the second note on this one, in which case the next bull run may be faster and come earlier than many investors expect, that is something I do agree with, okay? And I'll tell you why. When you look at previous bear markets, okay, and previous recessions and drawdowns inside the entire market as a whole, whether there's macros involved or not, obviously many times there are, you see a bit of a basing before we kind of get that curl. Now, there's two reasons why I don't think that will happen. One is the amount of cash, the liquid cash that is on the sidelines, and two, just the amount of market participants. Okay, so going back to 2001, 2008, the amount of market participants was a lot lower than it is now. There's a lot of retail investors that have taken much more control of their finances, whether that's managing their 401k a little bit more actively or utilizing their own investments like everybody who's watching this channel is, and therefore think that part has changed. Also, just the platforms that we're allowed to be able to trade on have changed so much over the past 20 years. So when it comes to that basing, I think it's going to be a little bit less than what we've seen previously. Do I think it'll be as sharp of a V recovery like COVID was? Well, probably not. And that's also because we didn't get a sell off. We didn't drop 33% in just a matter of a couple of weeks, like we did in that March of 2020. So keep that in mind. Okay. Now let's talk about the presidential cycle when it comes to sitting presidents in midterm years. So first off, the reason why I always look at, okay, especially when it comes to midterms, where things lie from a political standpoint is because, think back to 2016, 2017, when the Republicans, when Donald Trump won and the Republicans, went into office. You look at the sectors that benefited, one of them being the marijuana sector. Okay. The Republicans were, very, very verbal on their stance on marijuana, and were very, pro trying to, really their legalization into it. Okay. And so therefore all of your marijuana sector took a huge boom. Now, when, Biden was elected, obviously they're very pro into green energy, the incentives and so forth. And you look at EVs and charging stations and everything that has to do with green energy, and that entire sector, boomed. Okay. So that's why it's very good to kind of take a look at where things lie from a political standpoint. But it's good to know that the party of the sitting president tends to lose seat in Congress. Here is the one chart I will show you guys, and it goes back to midterms all the way to 1962. Now, right now, the Republican side is an 82% chance of taking the majority of the House, and while the Democrats still have a 52% chance of holding the majority in the Senate seats, it's good to know that, like I said, historically, the president's party usually performs poorly into midterms. Okay. Now take that one step further. All right. And this, little part excerpt really explains it, that the history suggests that the outcome of the elections really may not matter much. Okay. Certain sectors might benefit, certain sectors might hurt, but the overall stock market generally flags from the months prior, which we've seen. All right, the stock market did very well, okay, back in that August timeframe. Look at us all the way up at 430. September, October, really big drawdown, and here we are just starting to pop a little bit into it. Okay, that it tends to pop a little bit after them, and we get a little bit of a run. If you look at the statistics, it goes to show that these midterm years, the S&P performs better than other years, okay, from an average standpoint. However, obviously things are changing. We have a negative effect of a slowing economy. All right, and it might not be able to, outweigh the beneficial influence of the midterm elections. All right, so while I am staying completely neutral going through this, it's good to know both sides. Obviously, the charts are going to dictate, where things lie. Last thing I will point out about this before talking about the FOMC is the last time there was a recession in the year following the midterms occurred after the 1930 elections. during the Great Depression. It was a terrible era for stocks and the economy. That is quite ironic, especially when you add that the fact that the Phillies are playing in the World Series. If you don't know about that little comparison, look it up. Phillies last years that they won the World Series, it is quite ironic. You will be amazed. So let's get into FOMC before I wrap this up really quickly, guys. November 2nd, Wednesday. Obviously, the Mondays and Tuesdays, the days prior, volume's a little bit lower. You're not really seeing a trend. It's more just like a consolidation, and they're waiting for that. Here's where things have shifted, okay? And I really believe, I don't want to say, because we've been in a blackout period where the Fed, members haven't been able to speak. We're taking what happened up in Canada. Now, Canada raised 50 basis points. If you looked at where we lie, okay, a week ago, there was a 95% chance 1 week ago, okay, that the market was pricing in that we were going to raise 75 basis points. All right. And as of today, it's only an 82% chance. All right. So there is a little bit of despair. If that does not get more in line over, that next couple days leading into, the FOMC decision on a Wednesday, you can expect we get that 75. It's going to be a little bit of an impact. Market's going to pull. We get that 50. Obviously, it is still on the unexpected because the market's only priced in 18% for that. Expect the market to pop. All right. Now, things obviously have been changing to where the market can, react good on bad news, react bad on good news. Okay. So obviously, just let the charts really be that leading indicator for you. Keep this in the back of your mind going forward. So, guys, that's it for this video. I'll see you in the next one.